fiat currencies. German bond, Japanese yen, Chinese yuan. Those are all fiat currencies. And I'll get into a very big bill that has to do with cryptocurrency and stable coins. That's why a lot of people call it digital gold. Although I kind of lean towards Warren Buffett's view on it. Can't do anything with it. It's just sit there. It's a piece of metal.
Get ready for a new episode of KP Talks Dollars and Cents. Learn financial literacy and get real-time updates on all things housing, finance, and real estate. So let's get started. Here's your host, Kevin Perenio.
Hey, it's KP coming to you live from Corona, California. It's been like 2.5 weeks since I've been at the desk. I just tested my audio 3 times. Terrible, okay. Here's take 4. And we have a lot to get into. So I'm actually going to look at my notes, especially if I have to recut this long-ass video. So bear with me. Lots going on. Very important week. It ends with a bang. So we get our PCE, the Personal Consumption Expenditure, on Friday, which is the Fed's preferred measure of inflation. And it has a little less weighting on housing than CPI. But we kind of know some of the inputs. When you get the CPI and the PPI, there are some inputs that just go right into it. So we kind of have an idea what it'll be. 0.33 is the estimate I've heard. So we could see the number tick up to 2.8%, which I think is what's expected, even though that's a little bit higher than the 2.6 read we had last month. So, I say a lot on here that we're never really at the 2% target. So for like the last 40 years, we're at 2.4% on core PCE, which is the Fed deflator, what the Fed looks at. And if you go back to 1978 and do the numbers, the average is 3.4% because inflation was like huge in the late 70s and early 80s. So we never really get to 2%. However, we do have softening employment. We know that. And we are trending down, even if we go up 1 month and down 2 and then up a month on inflation. The U6 unemployment rate, something I looked up, it comes out with the jobs data on Jobs Day, first Friday of every month, it's at 8.4%. So it's up. So that's everyone looking for a job, not just the BLS number, the U3 number, which is a different calculation, kind of the main one that everyone uses. But people are still looking for jobs. So we will see what goes on. Speaking of looking for jobs, I just kind of getting caught up on email after being out of the office, and I'm reading some headlines from different articles over the coming weeks. Oh, the FHFA is going to, come in there and look at GSEs, and okay, we want to reform it. We'll make sure rates are good. And then all of a sudden on Friday, the Freddie Mac CEO was let go in a couple high-level positions. No justification given. And, what, do you have to come into the office for 5 days? What's going to go on there? It's very interesting. We have this debate on GSEs being privatized, but it looks like right now with our new FHFA director, Bill Pulte, of Pulte Homes, founder of Pulte Homes, that he's running it like a private company now. And I don't know what that means, what the end game is. There's some, obviously, look, if the Department of Education could be potentially eliminated or gutted, same with the CFPB, what does that mean for the GSEs? So it's very interesting to see this, this LFG, less federal government mantra really take place. And I don't know what's going to happen. So we're just going to wait and read the headlines and try and figure out how to run our teams here and run our business as a senior management team after whatever comes out. Who also doesn't know what's going on is the Fed. And they admitted as such last week. So in case you didn't get that video, they said, we don't know how to predict the future. We don't know what's going to happen even a couple months in advance. They use the transitory word again, which, I don't know. What does that mean? Does it mean a year? Does it mean 6 months? When it came to inflation during COVID, it meant like a couple years. So they said that the tariff inflationary impact would be transitory. So, of course, everyone had that guttural reaction. But April 2nd, we're calling it Liberation Day. The administration is calling it Liberation Day. And I'm trying to understand, what we're liberating from. And I'm reading the headlines just like everybody else. But it seems to be like some information that's been coming out says that the tariffs will only be kind of focused on what they call the dirty 15%, the dirty 15. So it's 15% of nations where you have a massive imbalance in trade. Now, I think this is interesting because it does work in concert with this whole concept we talk about here on this podcast, the flow of money, liquidity. Credit and money makes the world go round. And the Fed recognized at their last meeting last week that there isn't enough liquidity in the system for a growing economy. That's why they reduced their quantitative tightening. So instead of allowing $25 billion, up to $25 billion a month in treasuries to run off their balance sheet, they are going to only do $5 billion. And so, again, the mechanics of that is it actually is less liquidity tightening. And so it's not full-blown easing, but I think what they're starting to recognize is that there aren't enough dollars in circulation, treasuries in circulation, to do what we want to do, which is grow as an economy. Now, I find that interesting because of all the dot plots that we saw last week, which are a guidepost, and they all trended actually more hawkish, even though the statement and less quantitative tightening is very dovish. But all the dots basically said we're going to have a little bit higher inflation, a little bit lower GDP, and a little bit higher unemployment. That's very dovish, so you would think they would want to cut the rates. But again, less quantitative tightening is kind of a way to get there. They're not in a hurry. They don't want to make a bad move. And so they stand at the ready. And that's all we can hope for. And that, to me, is a Fed put. So I want to just underscore what a put means. So it's basically a floor, right? So we don't think this economy is going to go below a certain level, although the Fed won't say exactly what that is, or else they will get back to work and cut more funds and create more liquidity, maybe even reduce more of the tightening. And so, again, to release more treasuries into the world, to have more dollars circulating is a good thing. But I found it interesting that when they were talking about quantitative tightening, going that 25 down to 5 billion in less treasuries going off the balance sheet, the dollar has been weakening. And so, our currency is still the reserve currency of the world, and like 53% of all transactions in the world are done on just the US dollar amongst all the other fiat currencies. So fiat currency is what you call, countries' own domestic, currencies. German boon, Japanese yen, the Chinese yuan. Those are all fiat currencies. And I'll get into a very big bill that's kind of making its way through DC that has to do with cryptocurrency and stable coins, which, one of the whole, ethos about Bitcoin originally and cryptocurrency is that it's not fiat. It's not controlled by a government. It's not controlled by a central bank. And it's like this market that can't be controlled. And so that's why a lot of people call it digital gold, because gold is, this brick that's got some value with, thousands of years of value on it. Although I kind of lean towards Warren Buffett's view on it. Can't do anything with it. It's just sit there. It's a piece of metal, hunky there, and doesn't do much. And it's heavy, and you got to store it in these big old forts. But I digress. But the point is, if the dollar is weakening in light of more liquidity being potentially injected by the Fed or less quantitative tightening, what that says is there is a real fear of a growth scare. And so if our GDP does come down, which we get this week, the final reading for the Q4 GDP read, if there is less growth going on, maybe it's a transitory period where we're growing a little bit less because we're trying to figure out our new footing after we're liberated on April 2nd with all these tariffs in this new world order. And so, there's like $29 trillion in treasuries in circulation. And that's up from $16 trillion in 2019. Think about how much got expanded in the last 5-6 years. Sometimes you see some of these moves and you see like our government acting like we're broke, and we kind of are, right? We're on an unsustainable path. We have to reel some of our spending in. We have to reel in, this treasury issuance. But what's been interesting is, in the past couple of years, foreign buyers of U.S. treasuries was a pretty big part of it, and that, it's coming down. I have some stats here. So we're down to 33% of foreign holders of our treasuries from 42% in 2019. The Fed is shrinking their balance sheet. There went from 23% of all treasury outstanding to 15%. They've gone from 9 to under 7 trillion on their balance sheet. And they're on a run rate right now, although slower with this quantitative tightening slowing down, to get to like this median balance sheet that they've had since 2019, which is 6.55 trillion. So I don't know the magic number. I don't know the neutral rate. I don't know where they're going to go or where they're going to end or what the sign might be. Could be something that cracks. Could be another economy that falters. There are multiple economies out there, major ones, that are in recession or having slowing growth. Maybe they're in recession, don't know it yet. And so when those central bank fiat currencies collapse, that could be a sign of less liquidity in the system. So then the Fed has to cut and inject more in there. So the dual mandate is what's talked about all the time by the Fed. Stability in prices, inflation, and full unemployment rate. But the third one is moderate long-term interest rates, the 30-year long bond. Now, if those start to fall, because globally everything is growing, although the global PMI data out today showed an upside surprise of growth. But if those start to fall in this year, other central banks will cut their version of a Fed funds rate, and we follow. We follow because of the third part of the mandate. We need more money in the world to make the world go round. It's not just gravity in the sun. It's the U.S. dollar, believe it or not. If that doesn't sound egotistical, but it's the facts. It's what it is. So there's soft data and there's hard data. And I find it very interesting that there's so much of a discrepancy. All this soft data, like the University of Michigan sentiment data, where people are like, if you affiliate with one party, you think everything's terrible. If you affiliate with another, you think everything's great. And you've got CEO sentiment that's out there, builder sentiment that's out there. CEO sentiment's falling, builder sentiment's falling, even though they have tons of product out there. And first-time home buyers are stepping up. Cash buyers are stepping up. Purchase activity is great. It's ahead of last year. Rates are in a great spot. They've been trending down. And so there's sentiment, but then there's actual data. So one that I thought was very interesting, I saw this CNBC clip of Bank of America's CEO, Brian Moynihan. 1 in 2 Americans bank in some form or fashion with Bank of America. Savings account, checking account, credit cards, car loans, all that stuff. And the spending at the end of Q4, all of Q4, was up 4% in 24 versus Q4 of 2023. Through last Monday, so for 2.5 months, the first 2.5 months, with all this sentiment, right? Everything's terrible, it's awful, oh my God, tariffs, all this kind of stuff. The money actually being spent by their consumers and their data, 1 out of 2 Americans shows spending up the first 2.5 months 6% versus the first 2.5 months a year ago. And that's massive. People are spending. They're going out, spending on services, they're having experiences. Now, maybe, the baby boomer generation, which owns about half the net worth of this country, around 155 trillion and growing of net worth in this country, half of it goes to boomers. Maybe they're skewing the averages. So it's like in these soft data reports, there's some skewing of the averages. It'll all smooth out over time. We'll see what happens. But a global treasury collapse would be a deflationary act that would require intervention by the Fed. That's how it all flows. I got 2 minutes left. Bear with me. So if disposable income is up because wage growth is up, but inflation rises, your real wages go down. So watching inflation on this data and being data dependent, it matters because, my partner Gary Malice and I, we were talking earlier, people are fixed in these low interest rates. A big, chunk of homeowners have, really low rates. And so they fix that payment in for 30 years. So they have more disposable income, especially if their wages are rising. And that's good for the economy, but it could be inflationary. So we'll see. So the tariff stuff coming this week, I don't know. We're going to have reciprocal tariffs first on anyone that has a tariff on us. If they're not buying our treasuries, but we have to spend all this money to police the world and defend everybody, well, then, we're going to get it back somehow. So I guess we're going to put reciprocal tariffs on different countries. Ireland has pharmaceuticals. Germany has manufacturing. We'll see. Someone has one on us. We're going to put it on them. And if you don't want to buy our treasuries, then fine, we'll get it through the tariffs. And we got to float this big old budget that we have here, or else we got to cut some costs. And the biggest cost, the biggest entitlement is Social Security, $1.75 trillion a year in just Social Security. And so I found it fascinating, this CNBC clip where this guy that owns an engineering company went through and looked at like this 30-year project at Social Security Administration where they're trying to get off all the old mainframes and green screens and COBOL and all that kind of stuff and get to modern. It's been in the works for 30 years plus. And so they're just cutting off contractors and just figuring out all right, we cut someone off. Did something break? Nope. Okay, save some money there. Let's go to the next thing. and kind of cull through all the red tape and try and figure it out. EU backed off their whiskey tariff, so Colombia backed off some demand from the administration to get their $400 million for their university. So, some of it's working. Friday, triple witching, quad witching, all these contracts for futures and options expired. $4.5 trillion in liquidity contracts expired on Friday. And the stock market is ripping right now. So, not a financial advisor, not responsible for your losses, only your profits. I have so much more to go over, but I only get 15 minutes here. I'll be back from a very cool spot with Zactus Advisory Board in Deer Valley this week. Cheers.
Hey, it's KP coming to you live from Newport Beach. It's almost 11 on a Wednesday on the eve of the Zactus Advisory Board. I'm headed out to Utah for a meeting with them, 7 a.m. flight. Try and get about 6 hours sleep here, maybe if I'm lucky. That brisket and was so good in Austin that I had to try the turkey. So you guys know I was at the Stratmore event in Austin last week, and Salt Lake Barbecue is in the airport. Got a smoked turkey. So before that tryptophan kicks in, I'm going to try and get some nuggets out here. And then because we have Friday date of the PCE, which is super important, I'll try and get a video out again on Friday. So before heading to Zactus, our biggest credit provider, I've been reading all the stuff about AI and tariffs and trade and the stock market and all this data that's come out, all these housing changes from the FHFA and Fannie and Freddie, and thought I'd just get some stuff out real quick. But by the way, as you know, Ike Sura and I, we work together on the California MBA's co-chairs for this year's Mortgage Innovator Conference, which is in Huntington Beach, May 7th and 8th. And then on the 9th, it's the Women's Empower event on that Friday. So it'd be a great event. Susan Milazzo, our CEO, our longtime, rock behind the California MBA. She stands behind us together with Paul Gelati and Nick and, Sarah and so many others. So we've got Neil Sahota speaking. He is an AI advisor to the United Nations. He teaches classes at UC Irvine here in town, and he's going to have a ton of awesome nuggets. He spoke at the ICE Experience in Vegas a couple of weeks ago, and we have a bunch of VCs that have committed to come in and take a look at, some of the tech and the burgeoning tech that's going on, our tech showcase. Our sponsors, ICE, Poly, CoreLogic, which is now Cotality, cool rebrand that they have. They'll be there. Dark Matter. We have a ton of great sponsors. I can go all down the list, Friday Harbor and on and on and on. They're going to be there in addition to a ton of C-level executives that have already registered. So try and get out there. You can still get some early bird pricing, get some sponsorship in if you're a vendor partner in the ecosystem. And if you're a lender, it's free. Okay, so a lot of changes from Washington this week, especially as it relates to guidelines, right? So non-permanent resident aliens pretty much being X'd out of Fannie, Freddie, and Ginnie loans. We had to change our guidelines pretty rapidly today. We have some non-QM products that do offer a home for those borrowers, so we still have a home for them immediately. But DACA borrowers and non-permanent resident aliens are not getting government-backed mortgages with some of these changes. The special purpose credit programs, those are going away. Those are immediate. If you don't already have something in the pipeline, we didn't have one of those with Fannie or Freddie, but I know there's some companies that built a lot of their business models around that. And I heard it's possible that we don't have final word that Fannie Mae, I think it's called like the VLIP program. They offer $2,500 down payment assistance. That program might be going away. So there's a lot of stuff that's changing in DC in addition to the leadership. And all we can do is just sit back and deal with the changes and voice our opinions if we don't like it. I'll be up in DC. It's Advocacy Week for the Mortgage Banker Association. The Broker Action Coalition will be there. Advocacy in Action. I think the TMBA is going to be there, Texas Mortgage Banker Association. So 3 different great organizations in DC trying to voice some of our opinions. And by the time we get there, in about 12 days, just under 2 weeks, a lot more will probably be on the table. Of course, we'll be talking about some FHA changes and trigger bill legislation, and maybe whatever else is going on between now and then. Tariffs are coming. Liberation Day, as it's called, on April 2nd, and that will be out. to bring some finality, supposedly, on tariffs and what nations were imposing tariffs on. And then today, even though it's not Liberation Day, 25% tariffs against countries that don't produce cars in America will be levied. So 25% tariff. So it also counts for auto parts. So that will be disruptive. Now, is it a heads up for people to cut a deal before Liberation Day to let them know what we're thinking, who's going to benefit, who's going to lose? We're all watching it play out, but there's clearly some protectionism going on here, and I think that goes a little further than American exceptionalism, right? I get the idea conceptually we want fair trade. If they tariff us, we're going to tariff them. But I read an interesting quote in one of my stock subscription articles, and I'm totally going to butcher it because I only read it a couple of times. It basically said, changing the world is a great business plan. But sometimes you find out that, that there's a reason why they worked well the way they were. And so I'm sure not everything that comes out of this administration is going to work out. So be curious how effective they are at backtracking any of that. So now I talked about hard data and soft data. There's a big difference, right? So hard data is like tomorrow we get jobless claims report. We get the personal consumption expenditure report, inflation, the Fed deflated, the Fed's preferred measure of inflation on Friday. That's hard data. Soft data is like a survey. How do you feel? I feel like crap. I just ate too much, or I don't like this president and our economy is going to hell and inflation is going to go to 8%. You could write that down if you feel that way. And that's soft data. And so, the consumer sentiment data is out there. It's generally weakening. Now, soft data tends to precede hard data by about 6 months. So if we have about 6 months of this soft data of people feeling kind of bad about whatever, whether it's tariffs or a trade war, or maybe they just feel bad because they burned through their savings the last, 2.5, 3 years, or they've run up their credit card the last 2.5, 3 years, or it's too expensive to get insurance, or taxes are going up. Eggs, were too costly, although they've come down quite a bit. Waterfall dive in egg prices and cocoa prices. Oil's down pretty low. So there's a lot of things that make people feel bad. One thing I saw was that job switchers no longer make more money than job stayers. So that's turned negative. And it's been that way since COVID. And now finally, if you quit your job, the average trend is you will not make more money. And that is a weakening sign in hard data of the labor market. So we do have jobs week next week. So we'll get some more hard data on jobs in addition to the jobless claims we have tomorrow. So I thought that was very interesting on job switchers making less money when they switch as opposed to job stayers, who are being rewarded for loyalty and hard work and making more money. AI is very interesting. The International Monetary Fund put out a survey saying that countries like us in the UK, where 60% of jobs could be automated or could have the use of AI to automate them, will create this techno-chasm, right? The haves and the have-nots. Like a low-level job might be eliminated by AI, or you'd have to repurpose that person, which is what we try to do when we implement any kind of technology at our company intentionally. But higher skilled workers that learn how to use AI on their job are seeing an estimate of 170 million new jobs created because of AI by 2030. So there's definitely going to be a continued break because of AI. So we'll keep an eye on that and how it impacts the job market and all this hard data that's coming out over the months and years ahead. Now, back to the economy. There's a little bit of a Fed put. Right. Again, we talked about the Fed putting a floor on the market. They don't want it to go down too much. They recognize that we have a dollar shortage in the world to keep our economies going and to grease the skids of the economy. That's why they backed off of quantitative tightening and went from $25 billion a month to $5 billion a month in Treasury balance sheet runoff. They need more liquidity in the system, so we don't fall too far too fast if something breaks like labor. So, the dollar index is kind of in this range between 103 and 107. We've had a weakening dollar, but we're kind of in the range of 100 and 110. Oil, it's been between 60 and 80. If it falls below 60, that's a sign that demand is super low. And that's almost, another one of those big nail in the coffin signs that, we could be having a growth scare, possibly even recession. Remember the Fed said, Jerome Powell last week said 25% of the time, all the time, we are possibility of recession. It's always a 25% possibility of recession. But, some estimates lately have ratcheted that up a little bit higher because of, a growth scare that we're having in our markets. GDP information, the final number for Q4 comes out tomorrow. Shouldn't be any surprises there. But I'll be looking for the Q1 initial readings to come out in the coming weeks to see, how far growth is falling, right? So, durable orders were up. People are still trying to order stuff ahead of potential tariffs. And, if there's pull forward in demand, then, the next couple months typically don't have as much of a demand and people start to hunker down. However, it's spring, days get longer, weather's getting warmer, and people are generally pretty optimistic. In that time of year, we'll see if some of the seasonal trends can fight back. I'm not a financial advisor. I'm not responsible for your losses, only your profits. But, we hit a low here this month in the S&P and then rallied about almost 300 points on the S&P. Now, we gave some of that back today, about 65, 70 points. It's a little choppy, right? Until we get some certainty with earnings coming out starting next week. Start to get Q1 earnings, and the banks typically lead that off. So the financial centers will come out and say, hey, consumers still spending, consumers stronger than you think. There's still some savings there. They're healthy, their credit's good. The defaults aren't bad. I mentioned on my video 2 days ago about Bank of America CEO Brian Moynihan saying generally the consumer is good. So the money center banks could help us kind of get off this choppiness that we've had from all the tariff talk and uncertainty around what that's going to be. Should get some certainty April 2nd and then start getting some banks earning reports shortly thereafter for the first quarter of the year. So this week is a very important week in the stock market. It's called quarterly rebalancing. There's a lot of money managers that have to put money to work. So let's say this week there's like $40 billion just from money market funds that have to get put to work by these money managers. They're asset managers and allocators. And so there's been some good deals on stocks. That might have been why some of the prices have been rebounding since St. Patrick's Day, even 13th, the Friday before that. So, I think it's technically Thursday before that. But, the stock market had, a nice little pop up, and now it's slipping back. It may slip down further. I don't really know. But, the S&P did have a nice little range that it's working in. Same thing with the 10-year Treasury. Now, we're up against that resistance at 435. Will the data in the next 2 days push it back above that 435 resistance, or will it bring us back down to that range we've been in between 415 and 435? Now, what's interesting is if you read Les Parker's TMS Spotlight, he said that if oil gets below $60 a barrel, he thinks that gets us close to his June target of I believe it was 360 on a 10-year Treasury yield by June. Rates would be really good. So we'll keep an eye on that. Now, back to labor. We're getting hard data tomorrow. It's super important. So we'll have to keep an eye on that. But AI is a big driver. I mean, the cost for AI inference, if you will, has come down quite significantly. I'll give you an example. This is kind of a spectacular thing that I read. So for anyone that's using GPT-4, by the way, I just got Grok on my Android yesterday. It's finally available. It's actually pretty funny. It makes you want to use the GPT style interface. I wasn't really into kind of like the hard back and forth. It's kind of funny and conversationalist, so I'm starting to dabble even more than I was before. ChatGPT-4 tokens, okay? The cost to produce 1 million tokens, right? That's like all the information exchanging back and forth to kind of come up with the inference and give you responses and get to general, generative artificial intelligence, which is where our jobs really start to get at risk. It costs about $180 in the middle of 2022 to produce 1 million chat GPT-4 tokens. In just a year and a half, by the end of 23, it was like 75 cents. It's a 99.6% reduction in cost. And that includes electricity. So it's getting cheaper to get quicker AI answers. And, so we need to harness AI, the power of it, and learn how to use it, or else it could take my job. Maybe it'll do a video better than I will. Anyway, headed to Utah with Zach just tomorrow. I'll get back to you on Friday. Have a good one. Cheers.
You've been listening to KP Talks Dollars and Cents, a top-rated show for those who want to learn about the economy and mortgage environment. Tune in each week for more episodes, and please leave us a 5-star review on Apple Podcasts and Spotify. Kevin Perenio does not render or offer to render personalized investment or tax advice through KP Talks Dollars and Cents. The information provided is for informational purposes only and does not constitute financial, tax, investment, or legal advice. For more info, follow KP Talks Dollars and Cents on all of our social channels.